Recently, some of the students are asking doubts in marginal costing area, especially from decision-making problems. So as you know, this marginal costing, the full name of the topic should be marginal costing and decision-making. So actually, this marginal costing is not a part of costing. It should be part of management accounting. But since in CA intermediate and also in CMA intermediate, the subject is cost and management accounting, they have included this also in the syllabus. Your last 3 chapters in both CA Inter and CMA Inter, that is marginal costing, then standard costing and budgetary control. There are two parts of all these 3 chapters. The first part is in CA intermediate and the second part is in final. Especially for also for CMA, it is same. For example, if you look at marginal costing part 1 is in inter, marginal costing and decision making will be in final. Standard costing part 1 is in inter, standard costing and variance analysis will be in final. Budgets will be here in intermediate level, budgetary control will be at CA final level. Though they use the word budgetary control in CA intermediate level, you have only up to calculation of budgets. Next step is not there in CA intermediate level. So when you are solving these kind of questions, what we are going to see now, illustration 12 onwards, you'll see a lot of decision-making areas. Okay, so to revise the concept once again, in costing, we have 2 systems. One is absorption costing, second one is marginal costing. Which one is correct? Which one is to be followed? Which one actually is costing? The answer is, my dear friends, absorption costing. Absorption costing is the actual costing. Absorption costing follows certain standards. Absorption costing shall be considered by a business entity in the long run. But this marginal costing is there, no? This is for short-term decision making. That means, in this month, can I do this? This foreign order, can it be accepted? This additional sales order, will it give more contribution to me? Something like this. Something like this. And when you read global textbooks, I have come across one of the books from UK. I have read it recently, managerial finance book. A beautiful example is there about the marginal costing. What is that, you know? Suppose, for example, you opened a salon. You're a beautician or you're a barber. You are you have opened a salon. So your variable cost of dressing hair of a customer is 10 pounds. Variable cost is 10 pounds. Okay. And you have put the selling price 20 pounds. Your total cost is 16 pounds. So what is the cost structure of this new barber? So a new shop you have opened. So selling price, you are collecting 20 pounds from a person. Whereas your variable cost is 10. Your fixed cost is 6. Your total cost is 16. Your profit is 4. This is your cost structure. This is your cost structure. All rupees are in Great Britain pounds. Okay. Now, one fine day, a customer came to you and asked, hey, how much you charge for a haircut? You said, we charge 20 pounds. He took his wallet out, he checked and said, hey, I'm so sorry, I have only 15 pounds. And then he turned back and he said, sorry, I cannot afford you. And he's going away. Now in your mind, you're thinking of, hey, since morning, no one came. Since morning, no one came. I am hungry. I don't have work. I don't have money. I opened the shop and sitting since morning. Evening, one guy came and he's also going away. What should I do? What should I do? Now in your mind, you're thinking, if I take 15 and if I do the hairdress for this guy, if I take 15, my variable cost will be only 10. So still I will have 5 more pounds with which I can go to McD and I can buy a meal for me. I can buy a meal. But if I reject it, saying that my cost is 16, why will I do this for 15? My dear friend, this is 6 fixed cost is there. No, this is the rent of your shop, idiot. Whether you do the hair cutting for this additional customer or no, that room, that rent of the shop, the rent of the salon will not change. So you asked this customer, hey bro, wait. What did you say? I have only 15 pounds with me. Short-term decision. Next second, you're thinking he'll give 15 to me. My cost is 10. I'll get 5 more. Okay. Come, please. I'll do that at 15 for you. This is where marginal costing can be used. But if you do this at $15 or pounds for every customer, at the end of the month, you'll be screwed up. You'll not have enough money to pay rent. So you cannot do it in long run. Isn't it a beautiful way of understanding marginal costing? So marginal costing is for short-term decision making, but not for long-term. So the actual costing is absorption costing only. In the long term, even the fixed cost must be recovered. Then only you'll be in operating profits. Isn't it? Even when you look at inventory valuation and all, your international accounting standards, international financial reporting standards, or domestic accounting standards, whatever you follow, inventory valuation can be done only based on absorption costing. Marginal costing says all the variable costs will be charged to products and all the fixed costs will be charged to P&L. No, that is against accounting standards. So many people feel marginal costing is correct, but no, absorption costing actually is correct. Marginal costing is only for short-term decision making. Now let us see what type of short-term decisions we make in marginal costing. This example 12, illustration 12 is one of the classic examples for this. Okay, shall we do this? Processing of special order. Okay, read the question. PQR Limited manufactures medals for winners of athletic events and other contests. Its manufacturing plant has capacity to produce 10,000 medals each month. 10,000 medals you can manufacture. The company has current production and sales level of 7,500 medals per month. That means 2,500 medals. Capacity still there. You can manufacture another 2,500 medals also. But because you are unable to sell, you are not producing. So technically, you are utilizing 75% of plant capacity, remaining 25% idle. The current domestic market price of the medal is 150 rupees. So you are selling each medal at 150 rupees. The cost data for the month of August 21 is as under. Variable cost, direct materials 2,62,500. Direct labor cost is given. Overheads is given, fixed manufacturing cost and fixed marketing costs are given, total cost 10,87,500. Okay, so read the cost structure of the company once again. Read it once again. Then PQR Limited has received a special one-time only order for 2,500 medals at 120 per medal. At 120, what is your existing selling price? 150. What is the offer price of this one-time order? 120 per medal. Required. Should PQR accept the special order? Why? Explain briefly. Okay. 2. Suppose the plant capacity is 9,000 medals. What is the plant capacity? 9,000 medals, but not 10,000. Instead of 10,000, it is 9,000 each month. The special order must be taken either in full or to be rejected totally. Means what? If you accept the new order, since your total capacity is 9,000, 2,500 special order you accepted, your regular sales can only be 6,500. Otherwise, you have to reject this. If you do so, analyze whether PQR Limited should accept the special order or not. Interesting question. Okay, all of you read the question once again. Read the question once again. We'll do that. So, income statement as per marginal costing. Particulars per unit. Total. This is at present. This is at present. Sales per unit 150. Total 7,500 units. Okay, this is equal to this into 7,500. This is your present sales less variable cost. Materials, labor, overheads. Total variable cost, then contribution. Less fixed cost, fixed manufacturing cost, fixed marketing cost. Okay, then profit. You can write total fixed cost also here. Then you can write profit. So fill the numbers. Variable cost how much? 2,62,500. 2,62,500. So per unit how much? This divided by 7,500. Okay, this is materials. Okay, what about labor? 3 lakhs. 3 lakhs. Okay, how much it will be? 40 rupees, huh? Yes. Variable overheads 75,000. 10 rupees it will be, isn't it? All LKG calculations they'll give. Okay, now tell me what is total variable cost? 85. 6,37,500. So contribution, can I say sales minus variable cost? Okay, then fixed manufacturing cost how much? 2,75,000, 1,75,000. 2,75,000, 1,75,000. Okay, will not write in per unit column. If you want, you can write also, but it is not appropriate. Writing fixed cost per unit is not appropriate. So profit is equal to this minus this, 37,500. This is our existing income statement as per marginal costing technique. Okay, so just look at the numbers and try to understand it. Try to understand. If new order is accepted in situation 1, where your capacity is 10,000 units, here, what will be your sales? Look here carefully. If a special order is accepted, situation 1, case 1, if a special order is accepted, can I say sales is equal to, you will be selling 150 rupees selling price, 7,500. This is one sale, present sale, plus new sales 120 into 2,500. So your total sales is this plus this, 14,25,000. Now you are using full capacity. 7,500 your regular sales, 2,500 this special order. 2,500 special order at 120 rupees you are able to sell. Regular 7,500 you are able to sell at 150 rupees. Correct? Okay. Now this is equal to 35 rupees is material cost per unit into 10,000. You are producing and selling 10,000 units now. Similarly, all these things. Correct. So your contribution is equal to sales minus total variable cost, 5,75,000. And your fixed cost remains same. Correct. Fixed manufacturing cost will be same. Fixed marketing cost will be same. Total fixed cost will be same. Now profit is 1,25,000. How come? 5,75,000 contribution minus 4,50,000. So what is the conclusion we write? What is the conclusion we write? Since the profit increased by 1,25,000 minus 37,500, that is equal to, tell me how much it is. Is it 87,500? Is it 87,500? So your increase in profit is 87,500. It is advisable to accept the special order. This is how ICA solved the question, okay? But I'll tell you rather easier way of solving the problem. We will solve it in the exam like this only. But I am trying to explain you the logic, how it can easily be calculated. Simple. You know that when you sell one unit, you are getting a contribution of 65, correct? When you sell one unit, you will get a contribution of 65. Now special order additional sales. Special order additional sales. How much? 2,500. Contribution per unit. What is your selling price now? 120. Minus what is your cost now? 85. Variable cost 85. Selling price 120. Old contribution 65. But if you sell units at 120, you will get contribution 120 minus 85. Is it 35? Is it 35? So additional contribution. This into this will be incremental profit. Straight 87,500 will add to your profit. You understand? This is how it should be calculated actually. But I love this kind of answer. I love this kind of answer. ICA says. So you will present it like that only. But actually, this is how it should be calculated. 2,500 extra units if I sell, 35 rupees contribution I will get. So my additional profit will be 87,500. Existing profit 37,500. Additional profit 87,500. Total profit will be 1,25,000. Katam. Padam dishum. Now, if case 2, what they said, instead of 10,000 units capacity, now your total plant capacity is 9,000 units only. Okay. Your present sales is 7,500. Okay. New order came for 2,500. Okay. You cannot accept it in part. Okay. Either accept it or reject it. Okay. Will you accept it? How? We'll see. So here 7,500 units you are selling at 150. 2,500 units you are selling at 120. But now what happens, 2,500 units you will sell at 120, but you cannot sell 7,500 units now. You'll be able to sell 6,500 only. If you accept 2,500 capacity new order in full, your total capacity 9,000. Special order 2,500 gone. Remaining 6,500 only. So 6,500 units you'll be able to sell it at 150. You understand? So this will give me how much? 6,500 into 150 will give me 9,75,000. This gives me, I think, 3 lakhs. So both put together, it will be 12,75,000. But my cost will be for 10,000 units. Sorry, 9,000 units. Why 9,000? 6,500 plus 2,500. So this I will take into 9,000. I'll calculate. Okay, so this is total variable cost. Then this is sales minus variable cost. Then fixed cost remains same. Ta-da! Then calculate profit. Oh my God, 60,000. Better than present 37,500. No. At present, you are getting only 37,500. So even when your capacity is 9,000 units also, even when there is a condition that you should accept the 2,500 consignment in full or reject, even then you can accept the project. But here ICA has written one Very interesting insight. They said other qualitative conditions also should be taken into account. That means it should not disturb your present flow of business. No, for example, you have regular customers. That regular customers have come and asked you, hey, can I get 10 mementos? You should not say, sorry, sir, present one special order came, so we sold 2,500 to them. We cannot give you, sir. This will disturb your reputation. Those regular customers who are paying at 150, they should not be disturbed because of this. That is the intention of saying other qualitative points also are to be considered. And one more thing is, when you are running your plant at 100% capacity, always there is a risk. More repairs and maintenance can be there, or more strain will be there on the infrastructure. So these kind of points also you need to consider. That's all. So this is, my dear friends, problem number 12. Yes. So look at the answer. Present, they have 65 contribution. We got the same. 37,500 present profit. We got the same. Then 1,25,000 is the profit in situation A. We have got the same. In situation B, 60,000 is the profit. We have got the same. That's all, ladies and gentlemen. Okay, and see this. This is the beauty. Short-term decisions. Marginal costing will support only short-term decisions. You understand? So any doubts in this problem? Shall we see 2-3 more problems so that you understand it better?